Hey everyone, and welcome to This Explainer. Look, if you're a freelancer in the creative world, you know the hustle intimately. Whether you're a graphic designer glued to your desk, a photographer out snapping shots, or a videographer editing late into the night, there are absolutely times when trading services feels like the ultimate cashless win-win. Today, we're going to break down exactly how this works behind the scenes, so let's get right into it. Okay, let's dive into this. Picture a classic barter scenario for a second. Imagine you provide a local cafe with top-tier web design services, and in exchange, they offer you free coffee for an entire year. I mean, it's a beautiful dream, right? You get to build up your portfolio, gain some local exposure, and stay heavily caffeinated, all without demanding a single dollar of upfront cash from a client who maybe just doesn't have the budget right now. It literally feels like the perfect cashless transaction. But hold on a second. Is this actually a tax-free exchange? As much as we'd all love to think so, the central conflict here is that the IRS views this cashless exchange very differently than we freelancers do. While you're seeing a mutual exchange of skills and, great community collaboration, the federal government sees something else entirely. And ignoring this reality, well, it can lead to massive surprise tax bills or, worse, an audit. So, to make sure you leave this explainer fully empowered and protected, here's our roadmap. 1. The hidden cost of bartering. 2. The IRS bartering rules. 3. When bartering goes wrong. 4. How to report accurately. And 5. Smart bartering and pitfalls.
All right, Section 1. The hidden cost of bartering and why creatives love to trade.
So bartering is a practice as old as commerce itself, and in the freelance community, it's really a time-honored tradition. We totally get why freelancers, especially those just starting out, rely on these trades to make ends meet. You gain exposure, you build your portfolio without needing clients who have massive corporate-sized budgets. You foster really deep collaborative relationships, and, maybe most importantly, you save cash during tight times. You get the services or goods you need without dipping into your precious savings. It makes complete sense why we all do it. Moving on to Section 2, the IRS bartering rules, specifically topic number 420. Okay, but we gotta face the music here. The fundamental rule you absolutely must understand is that the federal government treats received goods or services as taxable income. Yes, even if absolutely zero money changes hands, the value of what you receive is income. So the crucial point is understanding fair market value, or FMV. Let's demystify this kind of intimidating jargon. FMV is simply the amount a willing buyer would pay a willing seller for the exact same service or product in an open market. It's basically what you'd normally charge or what you normally pay in a standard cash transaction. Let's look at how FMV actually works in practice. Imagine our freelance photographer shoots a wedding, a service valued at $1,500. In return, a florist provides floral arrangements for the photographer's own event, which is also valued at $1,500. Under IRS rules, both the photographer and the florist must report that $1,500 as taxable income on their respective tax returns. Now, brace yourself for some serious sticker shock here. That income doesn't just get hit with your standard income tax. Nope, it's also subject to a 15.3% self-employment tax, which covers your Social Security and Medicare contributions. So that $1,500 free trade just generated a very real, very unavoidable cash tax liability for both parties. And get this, if you're operating as a sole proprietor, which, let's be real, a huge chunk of creative freelancers are, you must add this bartered amount to your Schedule C. This means your cashless trade is directly increasing your business's reported profit, potentially leaving you with a tax bill you never ever anticipated and definitely didn't set aside cash for. Let's move to Section 3 and see how this builds. When bartering goes wrong, Sarah's cautionary tale. I want to show you how this creates real-world consequences with a cautionary tale about Sarah. She's a freelance illustrator based in Chicago, and she learned these rules the hard way. Sarah was super thrilled to set up what looked like an absolute dream deal. She provided custom artwork for local boutique store windows, and in exchange, she received $2,000 worth of beautiful boutique clothing and accessories. She got to showcase her art in a really high-traffic location and got a total wardrobe upgrade. And because no money actually changed hands, Sarah just assumed this was completely off the IRS radar. But here is the massive plot twist that hit during tax season. Sarah filed her return, only reporting the actual cash income she earned from her other clients. She was completely unaware that the boutique owner, doing exactly what they're supposed to do, reported the $2,000 value of Sarah's artwork as a business expense on their own taxes. And this brilliantly illustrates the danger of modern tax filing. Look at this mismatch. Sarah's reported income for this transaction shows a big fat zero, while the boutique's reported expenses show $2,000 paid out to her. This digital record-keeping mismatch instantly triggered an automated IRS notice for Sarah for unreported income. The end result? Sarah was slapped with back taxes, penalties, and interest. This supposedly free exchange ended up costing her over $800 straight out of her own pocket. With the increasing digital cross-referencing by the IRS these days, the chances of getting caught in a mismatch like this are honestly higher than ever.
All right, Section 4, how to report accurately and staying compliant with the IRS.
We definitely don't want you to end up in Sarah's shoes. So here is your exact action plan to protect yourself and stay fully compliant. Step 1. Determine a reasonable fair market value that reflects your normal cash rates. Step 2. Keep detailed records and written contracts outlining the exact exchange. Step 3. Report that FMV as income on your Schedule C. And hey, keep in mind, a Form 1099 NEC might be required if the barter exceeds $600. Step 4. Set aside 15 to 20% of the value in actual cash to cover that self-employment tax we just talked about. And finally, Step 5. Don't forget you can still deduct related expenses. If you bought materials to do the bartered work, those are absolutely still deductible business expenses. Finally, Section 5, Smart Bartering and Pitfalls and How to Protect Your Freelance Business. Transitioning into the final stretch of our explainer here, let's talk about the common traps freelancers fall into when they fail to treat a barter as a strict professional transaction. You got to watch out for these 4 massive red flags. First, underestimating FMV just to cheat the tax man is incredibly risky and it will trigger penalties. Second, failing to communicate with the other party creates the exact reporting mismatch that got Sarah audited. Third, ignoring state taxes. Remember, your state tax board wants their cut of bartered income too. And fourth, not seeking professional help. Look, if bartering is a big chunk of your business, you need a CPA who actually understands freelance nuances. Now, why this matters is that we want you equipped with smart habits to maintain your cash flow without any nasty tax surprises. Check out these best practices. Always create a written bartering agreement. Use bartering strategically as a stepping stone for exposure, not as a crutch for clients who just don't want to pay cash. Track this income separately in your accounting software. Proactively set aside real cash for the taxes and educate your bartering partners right off the bat so everyone is on the exact same reporting page. Which brings us to our final provocative question. Given the tax liabilities, the extra bookkeeping, and the lack of actual cash flow, is bartering still worth the hassle? Well, for early career creatives, building a portfolio, it absolutely can be a crown jewel. But as your business grows, remember that every single bartered transaction is a taxable event that requires actual cash to pay for it. I want you to reflect on how bartering fits into your specific business model right now. Treat it like a professional transaction and it won't bite you back. So what about you? Have you ever bartered as a freelancer? Did you know about all these tax rules beforehand? I'd love for you to share your own bartering stories and lessons learned down in the comments.